Welcome to the big screen on July 23rd, 2026. Thanks for stopping by and watching this video. You'll also be able to find a written post highlighting with charts what we cover here within 24 hours of this live broadcast. And you can find that on the big screen section of CanadianInsider.com. Now, the big screen is produced using data and analysis from the INK research platform. INK has been building its proprietary data warehouse and analysis for over 2 decades, which means we can provide you with insights on trends in stocks that you will not find anywhere else, just on the INK platform. And that includes inkresearch.com, CanadianInsider.com, and InsiderTracking.com. Now, before we get into today's big screen, first, let me say that anything you hear or learn on this video or through any publication on the INK research platform is for information and educational purposes only. It is not investment advice. We are not licensed financial advisors, so please consult a licensed financial advisor before making any investment decision. INK employees may hold an interest in any stock mentioned in this video or found on the INK research platform. Today, we're going to look at 4 stocks found in the INK Edge July Top 30 Energy Report, which we just published today. But before getting into the top 30, let's look at some broader insider sentiment trends that we see towards the energy sector. And there we go. There's the INK market report from July 20th. And so far, insiders have been fairly upbeat here towards the energy sector. And I'll bring it. This is the energy sector indicator coming up on the INK website. And we can see that on a 60-day basis, which tells you over the last 2 months, how many stocks have seen key insider buying for every stock that has had key insider selling, what the ratio is. And when it's above 100, that means there's more stocks with key insider buying than selling. We see that the indicator is over 100. It's at 104. So that is very, very positive because Canadian energy stocks, as tracked by the S&P TSX Capped Energy Index, have rallied 41.3% so far this year. And that was as of yesterday. However, despite this strong rally, insiders have been reluctant to take significant money off the table. In fact, the energy indicator, as I mentioned, is just over 100%. So that is quite remarkable because given this rally we've seen in the energy stocks, we wouldn't be surprised to see even more insider activity on the sell side. We're also seeing positive indications in the United States. And in the exploration and production area, we see the indicator, the U.S. Exploration and production indicator is at 150%. So that is also a positive sign because it shows that insiders on both sides of the border seem upbeat towards their stocks around current price levels. That brings me to the July Top 30 Energy Report, which we published this morning, where we highlighted that bullish insider sentiment provides us with a high degree of confidence. The pundits this spring and early summer who are promoting stories about an impending oil glut will be proven wrong again. In terms of the names that make up the top 30, they are identified by the quantitative INK Edge process. The INK Edge ranks stocks on the basis of value, insider commitment, and price momentum factors. We developed the INK Edge after the great financial crisis to put insider behavior into context, and the INK Canadian Insider Index represents the track record of the INK Edge. The index was launched in 2014. Over the past 10 years, it has outperformed both the S&P TSX Composite and S&P 500. And you can find out more about the INK Edge and the index in our Decade of Outperformance video, and I'll put a link to that in the description. By the way, the index has and a strong year to date. It is up 27.2% as of today, and that's more than the NASDAQ 100 and the S&P TSX Composite combined. The index did that with 100% exposure to Canadian stocks, mostly in the resource and industrial areas. So let's start off by looking at two names that we highlighted on January 7th in the morning INK report, and they have continued to rank high in our screens, and they earned spots in the July top 30 energy. Tamarack Valley Energy has been a big winner in 2026, advancing just over 81% since we featured it in the January 7th morning report, and that's as of today. Now that's better than even the SOX semiconductor ETF, which is up 69.5% in local currency terms. Now, Tamarack grabbed the 5th spot in the INK July top 30. Tamarack announced it had entered into a definitive agreement to sell its Charlie Lake assets for $804 million in cash. That completed a transition into a pure play Clearwater producer. At the time, Tamarack adjusted its full year 2026 guidance and expects average production of between 62,000 and 64,000 barrels of oil equivalent per day. Now that was down from the original 69,000 to 71,000 barrels of oil a day equivalent previously due to the disposition. Now, in connection with the transaction, Tamarack said it's increasing its quarterly dividend to 5 cents per share from 4 cents previously, beginning in Q3. Alberta's Clearwater Formation has entered the spotlight as the world scrambles for more secure supplies of oil as war continues in the Middle East. And Tamarack is one of 5 names in the July top 30 that are operating in the area, and I'll highlight one of those other names shortly. Now, just on that theme about the world looking for more secure supplies of heavy oil, there's a lot of speculation about when this will end in terms of the war in the Middle East. We suspect that this uncertainty alone will encourage more and more people to look for secure supplies of energy. That should provide a nice tailwind for Canadian producers, we think, into the near future. Total Energy Services was the other name that we highlighted to start the year on January 7, and it too has outperformed the SOX ETF, advancing 70.7% since the report. Total Energy Services took the number 6 spot in the July top 30. In Q1, cash flow was $1.46 per diluted share, up from $1.16 a year earlier, while net income was 65 cents per diluted share, up from 49 cents. Q1 results were released on May 12th, when a consensus was building that the war was ending. In its outlook at the time, Total said, should higher commodity prices persist, they are expected to provide a tailwind for increased North American activity. We have seen some two-way insider activity at Total Energy Services, with some recent insider buying this month. 2 directors acquiring a total of 1,810 shares at an average price of $22.29. Fuel marketer Alimentation Couche-Tard took the 14th spot in the July top 30. In our April 16th morning report, we asked if the gas bar and convenience store operator might benefit from the current oil price volatility, and the answer appears to be yes. When it reported fiscal 2026 Q4 results on June 22nd, Alimentation Couche-Tard said road transportation fuel gross margins of 52.44 US cents per gallon in the United States, with an increase of 9.17 US cents per gallon. I also saw nice margins in other regions. It went on to say fuel margins were noticeably strong during the fourth quarter, driven by volatility in commodity markets and amplified by the advantages of our integrated fuel supply chain. Rising margins helped to drive a strong earnings quarter. Adjusted net earnings attributable to shareholders were approximately US 73 cents per share on a diluted basis for the fourth quarter of 2026 compared to US 46 cents per share on a diluted basis for the corresponding quarter in 2025. So it seems like Couche-Tard had learned how to adapt to fuel price volatility, perhaps in the early days of the Russia-Ukraine war. The stock has risen about 14.6% since our April morning report, and we have not seen any insider profit taking, and that is a positive sign. You don't always need to see insider buying to have a positive indication of insider behavior. When a stock is rising and you're not seeing profit taking, that can also be a positive sign. Now I'm going to end today's big screen stock highlights with oil patch giant Canadian Natural Resources, which was number 24 in the July top 30. While Canadian Natural is known for its bitumen mining and upgrading operations at Horizon's oil sands project, it is also targeting the Clearwater Formation. And we were encouraged to see Director Steve Lott buying at the oil patch giant earlier this month, before the latest move in crude oil, the latest rally. Mr. Lott was a former executive vice chairman of CNQ, and he already has substantial holdings. However, the fact that he even modestly added to his position since the stock came off its all-time high of the 70.99 on March 30th, that's a positive sign. Moreover, there has not been any insider selling since the stock set its all-time high. In Q1, CNQ reported average production of 1.643 million barrels of oil equivalent per day, 72.9% liquids, and that was up 4% from Q1 in 2025. In March, Canadian Natural also upped its quarterly cash dividend by 6.4% to 62.5 cents per common share. Canadian Natural has defied the cyclicality of the oil business by increasing its dividend 26 years in a row with a compound annual growth rate of 20% over that period. Just looking at where we are in the energy sector right now, there's always worries. Have we seen a peak? Are we going to get a ceasefire? Are we going back to the oil glut? Look, our view is we will have a really good idea from the insiders when this oil rally is coming to an end or is peaking, because all our charts, all these charts you see here on the screen, such as with the Canadian Natural, there'll be a lot of red on those charts, and we don't see that right now. When we see red on all the majors and the juniors across the board, then we'll start to really wonder if we've exhausted the energy rally. But we do not appear to be there yet. In fact, as I mentioned earlier, we still have our indicator slightly above 100%. So we still seem to be, I think, in early days in this energy bull market. Doesn't mean there's going to not be pullbacks. There's going to, if we get a media report saying, oh, there's going to be a ceasefire, a pause, maybe there'll be a big theatrical explosion or a bombing of a facility in Iran, and people think, oh, that's it, we're back to peace, or we've peaked. Well, there are other factors we think at play, including, as I talked about in November, kind of this slowing U.S. production growth that also come into play. So let's keep an eye on what the insiders are doing. Right now, it's very constructive, very positive, and there still seems to be plenty of opportunity in the oil patch. But we'll keep an eye for the red to show up, but we haven't seen enough yet to cause us any concern. And with that, I'm going to want to say thank you for stopping by and listening to our big screen. If you enjoyed this podcast or got something out of it, please give it a like. And that'll encourage us to continue with them and keep providing you this kind of insight, maybe some ideas that maybe you don't hear anywhere else. If you're not a member of the INK platform, you can join us for free as an intro member at CanadianInsider.com, and you can get a free watch list, and you can get access to some additional tools. So I would encourage you to do that. But most of all, I want to say again, thanks for stopping by, and all the best for a very profitable, happy, and safe summer. Until next time, thanks again.